everyone, welcome back to our channel. If you're gearing up for a financial analyst interview, you have come to the right place. In today's video, we are diving into the top questions you'll face and more importantly, how to ace them with confidence. Whether you are a fresh graduate or a seasoned pro, stick around because these tips could be a game changer you need. But before that, make sure you're subscribing to this channel so that you do not miss out on any new updates coming on our channel. Now we shall start off by beginner level questions and work our way up to the advanced level questions. So let's start with beginner level questions. Number 1. What is finance according to you? Now this is a question that the interviewer will ask you to make you comfortable and to start the interview in a very comfortable zone. Right? To answer this question, you can go something like finance is a broad term comprising money, investments, capital markets, debt, banking and credit among various other aspects. Essentially, it refers to the act of managing money and procuring necessary capital for various purposes. Now, financial professionals oversee, create and study financial systems including money, assets, liabilities, banking, investments and credit. The three primary financial types are corporate finance, personal finance and governing body finance. So these are the elements that you need to cover in your first question. Then comes, how can a company show positive net income but go bankrupt? So a company can show positive net income while facing bankruptcy by basically deteriorating the working capital. What does this mean? This means by enhancing the accounts receivable and reducing the accounts payable. Question number 3. What does working capital mean? So this is also a very general question that is asked in the finance related interviews. To answer this, you need to go something like working capital is the amount you get after deducting current liabilities from current assets. It tells you how much cash is tied up in the business through inventories and receivables and how much cash you need to pay off the business's short-term obligations. What does short-term obligation mean? Basically something that is less than 12 months span or 12 months span. Question number 4. Why do capital expenditures increase assets when other cash outflows don't and instead create expenses? So the answer to this would be capital expenditures are capitalized because they give benefits to the firm for a substantial amount of time. For example, a new branch would make a lot of money for the firm for a long while, but an employee's work will only benefit until the time of paying the wages, and that's why they create an expense. This is the primary difference between an asset and an expense. Next, question number 5. Explain a cash flow statement. Now this is one of the business statements that are out there, be it income statement, balance sheet or cash flow statement. So we are focusing on cash flow statements. First, we start with net income. Proceed line by line while making adjustments to arrive at cash flows from operations. Now this is a keyword right here. Now you will have to mention capital expenditures, purchase of intangible assets, purchase or sale of investment securities and asset sales to arrive at the cash flow from investments. This is the second keyword in cash flow statement. Then after getting the cash flow from investments, you need to mention the issuance or repurchase of equity and debt and paying out dividends to arrive at the finances. Then you need to add cash flows from investments, operations and financing to get the total change in cash. Finally, the cash balance at the beginning of the period and the change in cash lets you arrive at the cash balance of the period's end. This is essentially what a cash flow statement looks like. Can a company show positive cash flow while facing financial problems? So this is a basic finance interview question. Yes, a company can show positive cash flows even while facing financial trouble through impractical enhancements in working capital. What does this mean? Basically delaying the payables and selling inventory, or by not letting revenue go forward in the pipeline. Next question is, what do you mean by preferential capital? In simple words, preferential capital refers to the amount raised by issuing preference shares. This is a hybrid method of financing the firm as it offers some features of debentures and some features of equity. It is the capital that has preference over equity capital at the time of dividend payment. Next question is, what do you mean by hedging? Now this is also one of the most important questions that are asked in finance related interviews. Hedging is basically a risk management strategy we implement to offset losses in investments. We do so by taking an opposite position in a related asset. However, the amount of risk hedging reduces results in a similar reduction in the potential profit. You can say that hedging is similar to having insurance where you can pay a certain premium and get assured compensation. With hedging, if the asset in question causes you a loss, the opposite position in the related asset will make up for the loss. This is why a hedger is quite different from speculators, as the hedger does not focus on maximizing profits but instead focuses on minimizing the risks. Next, what is WACC and how do you calculate it? The weighted average cost of capital, commonly known as WACC, is a financial measure that signifies the average expense associated with funding a company's activity. This metric considers both the cost of debt and equity, taking into consideration their individual proportions within the company's overall capital structure. WACC is employed to assess the desirability of an investment or project, serving as an indicator of the minimum return anticipated by both debt and equity investors. The formula for calculating WACC is as follows: WACC equal to EVRE plus DV RD 1 minus TC, where E is the market value of equity, D is the market value of debt, V is the total market value of the firm's equity and debt, RE is the cost of equity, RD cost of debt, and TC is the corporate tax rate. Next, we will move on to the intermediate level questions that are asked in finance related interviews. So, number 1 is, what is RAROC? Now, RAROC stands for Risk Adjusted Return on Capital and is a risk-based profitability measurement framework we can use to analyze risk-adjusted financial performance. It gives a proper view of profitability across organizations. It is one of the best tools to measure a bank's profitability. By combining it with the risk exposure and the ascertained economic capital, you can calculate the expected returns more accurately with RAROC. Next, what do you mean by fair value? Now, this is something that is commonly asked in finance related interviews. Fair value refers to the unbiased and the rational estimate of the potential market price of an asset, good or service. The fair value of an asset is the amount at which you can buy or sell the asset in a current transaction between the willing parties other than a liquidation. Similarly, the fair price of a liability refers to the amount at which you can incur or settle in a current transaction between two willing parties other than a liquidation. What do you mean by secondary market? Now, secondary market is where people trade securities that have been offered to the public in a primary market beforehand and are listed on stock exchange. The secondary market is also known as aftermarket, and some of the prominent examples of them include Nasdaq, Bombay Stock Exchange and New York Stock Exchange. Next, what is the difference between cost accounting and costing? So the interviewer might ask you this question just to mess around with you and to know whether you know the basics or not. So costing is the process of identifying a product's or a service's cost, while cost accounting is the mechanism of analyzing a business expenditure. Cost accounting is a branch of accounting that determines the expenses incurred from a venture through examining, analyzing and predicting the cost data. On the other hand, costing is the process of asserting the cost and the prices of products. Costing is a technique, while cost accounting is a branch of accountancy. The former has a very little impact on business's decision making, while the latter is crucial for informed decision making. Next, what do you mean by cost accountancy? And do you know the objectives of cost accountancy? So this is one of the great finance interview questions that is commonly asked. Cost accountancy is the combination of costing and cost accounting, where you classify, record and allocate expenditure to determine a product's or service's cost. It records and analyzes the related data and presents them appropriately to help in guiding the decision making process. Following are the objectives of cost accountancy. Number 1, to get correct analysis of cost, be it by the process and different elements of cost. Then to ascertain the cost per unit of various products. Then to ascertain the profitability of every product. Then to advise the management on how they can maximize their products. Also to disclose the sources of wastage, be it time, resources or money. Next, explain financial risk management. This is among the most important interview questions related to finance. Identifying, assessing and addressing the potential risks that may jeopardize or affect an organization's financial health, thereby affecting its overall health, is termed financial risk management. These risks can arise from various sources including market volatility, credit fluctuations, liquidity challenges and operational uncertainties. A financial risk management specialist must develop strategies to mitigate the identified risks. Diversifying investments, setting up contingency plans, using financial derivatives or establishing insurance coverage are some strategies that can be adopted to mitigate potential risks. It also involves constantly monitoring and reviewing the risk management strategies implemented. Next question. Briefly describe a dividend growth model. The dividend growth model, also known as Gordon growth model, is a method used to estimate the inherent value of a stock by considering its expected future dividends. The dividend growth model assumes that dividends will continue to grow at a constant rate indefinitely and is suitable for companies with a stable growth rate in dividends per share. The formula for dividend growth model is value of a stock equal to D1 K minus G, where D1 being the next year expected annual dividend share, K being the discounted rate, G being the expected dividend growth rate. Next, why is PP&E important and how do you record it? So, recording property, plant and equipment is an essential accounting process that involves recognizing and maintaining accurate records of a company's long-term tangible assets. These assets typically have a useful life of more than 1 year and are used in production of goods and services. The process of recording PP&E involves 3 steps which are as follows. Number 1. Initial recognition. We have to start by capitalizing on the cost of acquiring or constructing the asset, including all costs necessary to bring it to its intended use. Number 2 is measuring. Next, we will record any subsequent costs that enhance the asset's future economic benefits, followed by applying depreciation or amortization over the asset's useful life. Then comes impairment testing. Finally, we will assess for impairments to check if the asset's recoverable amount will be less than its carrying amount. Now, let's talk about the advanced level questions that are commonly asked in finance related interviews. First, what do you mean by adjustment entries and why do we pass them? So, the entries we pass at the end of every accounting period to the nominal and related accounts so that we can indicate the correct profit and loss in the profits and loss accounts and keep the balance sheet accurate are called adjustment entries. It is crucial to passing adjustment before we prepare the final financial statements, as in their absence the final statements would reflect incorrect information resulting in error and confusion. Moreover, the balance sheets wouldn't show the accurate position of the businesses if we don't pass the adjustment entries. Number 2. What do you mean by the put option? Now, put option is a financial market derivative instrument that allows the holder to sell an asset at a specific price by a specific date to the writer of the put. The purchase of a put option sends a negative message about the future of a stock in question. Question number 3. What do you mean by deferred tax liability? This is one of the advanced interview questions that is commonly asked. Deferred tax liability is the amount the company hasn't paid yet to the tax department but is expecting to pay in the future. It happens when a company's tax expenses are less than the amount they reflect in their tax reports or financial statements. Next, what is goodwill? Now, goodwill is an asset that contains the excess of purchase price over the fair market value of an acquired business. Finally, what is the difference between a journal entry and a ledger? Now, this is also one of the most important questions that are commonly asked in finance related interviews. So, the journal is the book of prime entry and all the transactions are recorded in it to show which account got debited and which one got credited. However, the ledger is the book for keeping separate accounts. You'd have to classify the recorded transactions in a journal and add them to the dedicated accounts present in the ledger. The ledger is also known as the book of final entry. Thank you for joining us and good luck with your finance interview. Make sure that you subscribe to this channel so that you do not miss out on any new updates coming on this channel.